Welcome to Come and See, your podcast for finding truth in a world of chaos. Brought to you by All for Jesus Living Waters Ministry. With host and founder Richard Case and co-host and retreat leader Kathy Ricconi. Jesus reminds us to watch for the signs of his return. Today we will explore further what we are seeing in our times that line up with what signs he said would indicate the potential of the end and his return. We will also discuss the practical meaning of this as we watch and as a remnant prepare as he so leads. And now your host, Richard Case.
Well, good morning, Kathy. Here we are, End Times Friday, and the end of April. And
April 28th.
We've been having some interesting discussions about banking and investments and what to do with them. We'll talk a little bit more about that, today. One thing that you, after our last session, you said, well, how do you get that information?
Right. And it's not as easy as it appears to be able to find that, right?
And I've looked at it before, but it was like, okay, let's go get it again. And we found out it's not that easy.
Yeah.
So we're gonna actually share that right now. The question is this: with Silicon Valley Bank failing, and then First Republic right behind it, and remember, a failed bank is that their cash and equity position falls below the ability to basically function correctly.
Right.
And you can't manage typical, business operations. So, and it happens, and I imagine people have seen pictures of what happened during the Depression. And it's called a run on the bank.
Right.
Where in that case, because it was all, remember, it wasn't electronic, it was all paper money. Well, people would line up and go to the teller window and say, give me my money, and then they'd start giving it to them, and then people would line up, and they finally they close. Remember, remember if you picture that, they closed the window,
right,
and said,
there was no more money.
We don't have any more money to give you, so we're done, And then the bank has had a run on the bank, and they have to either recapitalize or they fail. And because of the bank failures actually of the 1930s, the FDIC, the Federal Reserve, came in and said, we'll insure bank accounts up to $250,000 for every individual, either Social Security number or a federal ID number, a business number.
The EIN, right.
So, and by the way, if you put bank accounts in the name of your children, they have separate Social Security numbers that count, start at $250. So the more you can spread it out, the better. Of course, you don't want to give your kids access to the money. So then what happened with Silicon Valley is that because of they were losing money on what they did is, in essence, they made long-term investments at a very low rate because it was satisfactory. The assumption that they made, which is a bad assumption, is these rates will be maintained. And number two is that in the event that it changes, we need to have a different portfolio so we can be covered in that event. And so the lack of wisdom of the leaders of that bank is, in essence, they bet something and assumed something, and it turned out to be the opposite.
Yeah. So they were operating at a much higher risk than they should have been.
Yeah. And so they're
investing in
now they're losing profitability and therefore eating into their capital. And when you start eating into your capital, particularly when there's no remedy for that. So it wasn't like, well, we have other things that can make it work. It was like, we're stuck, and it's going to get worse and worse and worse and worse and worse. And so the depositors, who and these are informed people, who watch this stuff, like, wait a minute, they're going to get worse and worse and worse.
Right.
Because
and they start pulling their
then
funds,
I'm going to pull and they have a run on the bank. And they did 40, and now it's electronic, so you have to show up at the door.
Right.
$42 billion was withdrawn.
Right.
And it took everything now way, way below it, and they couldn't function. And so the Fed closes them, said, that's it, you're done. We have to take it over, which they did. It's called a failed bank. They took it over. All the investors, they're gone. They get nothing. So if you invested in that bank as a stock owner,
right,
you're out. You get zero. Normally, they said, well, if you have bank accounts up to $250,000 per number, we'll insure that. Well, it just so happened that this bank, and your husband Dan had his company was part of it, is these are banks that have run through private equity firms and have put millions and billions of dollars into that bank, and they, in essence, weren't insured, and they were going to lose it all, and that would have tipped the whole country into a severe recession.
Right, the ripple effects of that would have been
so
huge.
the Fed said, okay, hey, we'll keep everybody whole. We don't have to, and it's not a rule, but we will. And as a result of that, people got their money back. But the way they solve it is they have another bank purchase that bank, because there's still assets there, deposits.
Right,
because they couldn't get them, so they're there. So, so another bank buys them, combines it with their thing. They write off the bad investments prior to taking it over. So they only take a clean, basically, balance sheet, because everybody's lost it already. So what difference does it make? Now we're going to be part of a healthy bank system, and the Fed, is providing capital to the banks to do that.
Yeah, I was going to say they give them incentive and assistance to be able to do that.
That's right. So they did. Well, what that caused was a concern, like, is it just that bank?
Right.
And
How many more are operating?
The answer was no. So as you look at these different things, we can then say, well, what about my bank? And
right.
that was your question.
And that was where my question came into you. I'm like, okay, walk me through this. If I want to know exactly what is going on at my bank in particular, where do I go? What do I look at?
Right.
What numbers, letters, everything am I concerned about?
Right. So what do I do? And how do I evaluate my bank? And so I'm going to bring up something here. It should show up on the screen, but this was Moody's. Moody's is a rating system that basically, and this is about governments, banks, companies. They put out a rating every month of, are they going up or down, stronger or weaker? And in this case, this is right after it failed, and this is what it said. Now, by the way, they published this and haven't published anything since, and I'll tell you why in a second.
Okay.
This was, remember, it happened on a Friday. The credit rating firm late Monday put out Signature Bank, which failed Sunday, into that territory. So Signature Bank already had failed,
Right.
And they had to take that over. Moody's issues another warning for these banks. First Republic Bank, Zions Bank. Interesting enough, Zions Bank is my bank. So I'm doing something about that. Western Alliance, right. Comerica, UMB Financial, and Intrust Financial. So they gave the list of these companies, which, by the way, after they did this, the Fed came to them and said, stop that.
Right.
Stop
putting the information out.
Stop putting information out of who is going to be downgraded. Now they'll keep downgrading, but they're not going to overly publish it. You're going to have to look for it. One, and
just
two.
To say real quick.
Go ahead.
Rich and I literally just spent what, 20 minutes sifting through some things
Yeah.
online because it was so hard to find some of this information now
Yep.
that used to be readily accessible.
Yep. And then the Fed that has their own watch list. You can even look on it online. They have a watch list. I couldn't get to it because it was said we purposely don't publish it because we don't want the 150 banks that are on the watch list for it to be what you called before a self-fulfilling prophecy. If you know, then you're going to take your money out and you're going to actually accelerate the problem.
Right.
So they don't purposely publish it even though it's there. Well, there is a way to find out something. Let's go there. The question came up, and I made a mention of this, called the Texas ratio.
Mm-hmm.
And it's just a term that was determined, when the banks were failing. And I think it was stimulated out of the state of Texas that, well, we need to evaluate the health of these banks. And so because it was done, I think, by Texans, they called it the Texas ratio, which means
Okay.
all of the banks in the United States are analyzed by this Texas ratio.
Right.
And it's just a simple measure of many factors, which I'll show in a second, but of the healthiness of the bank. And if it's above a certain point, it's unhealthy. If it's below a certain point, you consider it healthy. And then you got to keep watching it,
Right.
So for your bank, what I would urge you to do is learn this. So let's go there. I'm going to take you through this. There's a website called bestcashcow.com/banks. We could even go one step and just say, okay, let's just go to the website, bestcashcow.com. And we go to that website, and up on the top there is banks. So we click on banks. We then go to all banks, and you can put the name of your bank, or you can go to these alphabetical, and there's a list of them. But I put in Chase just because I know that bank. I don't have that bank, but I know that bank.
Right.
I click on Chase, and then Chase Chase comes up. I think you can hear Linda in the background.
I can. I do love her laugh, though.
She likes to laugh. I'm going to try to text him one more time just to
Remind them. Yeah, so this is helpful. While you're doing that, it's helpful to pull this up.
Yeah. Okay.
And
So
just
then,
look at it yourself and
so then
navigate it.
I put my name, my bank, Chase in. There it is, Chase, J.P. Morgan Chase. Click on it. There it is. And then I'm going to start to look at it. So then I've got the bank. Hold on, let me get the thing here. Hold on. Okay, so
You have
then
to
when I go
scroll a
down,
bit
when I
to
go
get-
down,
but you can get to the Texas ratio. Then.
well, okay, so I hit the banks up here, and now I'm scrolling down until I see this red thing across the top. Overview, deposit rate, loan rate, branches, etc. I click on financial details, and there's the Texas ratio.
Okay.
Okay, their bank, now the lower the better.
Right.
So the lower the better. So they're rated green, healthy, 2.72 versus the bank average of the United States of 4. And so then you can scroll down, and return on equity is about the same. Capitalization is strong.
Okay.
Balance
So
sheet.
you're looking at a few different things. You're not just looking at the Texas ratio. You're looking at a few different things.
Right, and you're seeing your income statement, et cetera. And so if, and it goes here to, commercial real estate, for example, 3.7%, and they check it, as saying that's very low because why? Well, commercial real estate is in trouble. So that's
Okay.
really high. Credit card loans is high, so they're a little bit at risk, with that. So
Right.
anyway, you can look at it. The most important thing is this Texas ratio. That if it's above the U.S. bank average, particularly if it's 7, 8, 9, 10, 15, your bank's in trouble.
Right.
And you need to go look at it because their ratios of capitalization, loan portfolio is not healthy and likely going to fail. And so as you look at that ratio, you would say, boy, my bank is poor, so I'm gonna go and consider, and this is where you got to pray and process, should we consider moving our money to another bank? And then, by the way, when you do, which is, by the way, what I'm doing, my bank is actually on the watch list. It's known on the watch list. In other words,
Right.
it's in trouble. so, so,
So you are looking at making moves
so
and
I'm
how you do
making a
that. Yeah.
move, and so I'm looking at, and one of the ones I'm looking at is Chase, because the Texas ratio is very, very strong. Okay, I'm going to just give you a comparison. I'm going to go back to banks.
Mm-hmm.
I'm going to go down here to all banks. Sorry, go to all banks. I'm going to look at just look at Bank of America.
Okay.
That's a pretty big bank. I'm going to go to Bank of America, and then I'm going to go here. It's going to come up. Okay, now I'm going to scroll down. So I get that. There it is. Financial details. There it is.
Mm-hmm.
Texas ratio is 2.45, so they're pretty good shape too.
Okay.
So that would be okay. That'd be one that I could look at. Let me try one more. Again,
Yeah, I just pulled up two that I'm familiar with. One is at a 2.05% and another is at an 11.54.
okay.
So at what point when the national average is 4.05, at what level do I get concerned?
Right. Well, it would be anything over 5 to 6. Is that 11 is bad news.
Okay, so like that second bank, the one that's 11.54, that would be a red flag. I should be paying attention to that. Okay.
Yep. So
Whereas the 2% one, that's I can say, okay, I'm pretty safe in that.
right. So let's
How
look.
often do they change these?
Every month. Every month.
Okay,
So I'm going to look at one more. I'll just look at Wells Fargo.
great. That's a good one to look at. Yeah.
Okay, Wells Fargo. Here we go. Scroll down. There it is. Financial details. They're at 58.86. They're not healthy. That's already that's 50% higher than the U.S. bank average. They're tending toward being unhealthy. So if I'm going to make a switch, just based on that alone, I'm going to go to ones that have a really good Texas ratio. Now remember, they're measuring their investments and they're measuring their loan portfolio.
Okay.
And they predict, like for example, they might have a high percentage. It'll be interesting to see. I could actually look at this. But let me go down here and see. Okay, loan portfolio. Commercial auto loans are very high. Guess what? A lot of them are defaulting.
Defaulting.
Commercial real
Interesting.
estate.
Okay.
Commercial real estate is medium, defaulting. Multifamily mortgages, medium, defaulting. These are all potentially in trouble and going to get worse, and they already have a high Texas ratio. So I would look at this and say, well, if I'm going to move my money, probably it would not be a great idea to move it to this bank. I'm going to go find one that has a low Texas ratio and doesn't have
Right.
a lot of medium to high loan problems, particularly if I know, like credit card, or excuse me, with auto loans and commercial real estate, that's going to go worse. for sure. That's going to go worse for sure. So, you can use wisdom. And then again, Father, do I need to? Is it important? Do you even care about this? So it's not universal. It's just some tools to be able to use. If you have a heart to consider that, and to remember.
This is fascinating to me. It's
watch
something
the signs.
I've never learned about before. So.
Yeah. So would urge you to look at it, and then on top of it. So that's a banking scenario. The other piece of our life is the situation with the economy and what we're headed for, a recession. And they're working really hard to say it's going to be a mild recession. Right.
But statistics are showing that may not be the case, right?
Right. So it's such that it's going to. We think, based on the information being provided, that it's going to get worse. And by the way, it could be stimulated. One of the things that could stimulate it is the defaults on the commercial real estate.
That's interesting.
And think about what's happened. Is we had COVID.
Right.
And what happened during COVID? People stopped going to work.
So many, yeah.
Well, they were told they couldn't go to work. So they didn't go to work. But the technology was still available, and actually a technology called Microsoft Meeting, Zoom.
Right.
Well, you can just have meetings online.
And this all permanently shifted the face of how businesses interact and interface and what their employees do, and even the expectation of the generations coming up. They're coming in and negotiating X number of days remote work because that's a better lifestyle for them.
And by the way,
it leaves a lot of commercial real estate empty.
You don't waste a lot of time commuting. So they discovered, well, business can actually work pretty well that way. And there's still need for office space, but it's more meeting together, and it doesn't have to be all the time. And you don't need as much space for sure.
More room for flexible space for sure.
So just think of the simplicity of the volume. Like, for example, in New York City alone, there's 100 million empty square feet of office space.
Wow.
Just today.
So what are the plans to do with, do they have plans to do something with that? Are people talking about how do we reinvent this?
Well, yeah, they are. But the problem is, remember, it's a fixed asset and it's not liquid.
Right.
So you can't just change it. By the way, generally speaking, the people that are, and by the way, these are pension funds and government funds and called REITs, real estate investment trust. They bought these when they were full.
Right.
And it's called a based on cap ratio of income. So I pay you X dollars based upon the value of that income. Okay, so they do. Well, today they own those buildings and they paid X for it, let's say $100 million for a building. Well, that building today, because it's empty or a lot empty, and people are not renewing. See, the problem is that now the renewals of those leases, and because of the term, I'm at the end of my term, I don't have to renew it by contract. So it's not like, well, I'm still stuck with it. At the end of my renewal, my lease, I'm not. And then, you know what? I'm not leasing it either at all, or I'll take, instead of 100,000 square feet, I'll take 10. Well, now I have empty space.
Right.
Okay, the value has dramatically declined. Okay, now as a investor, either I'm going to have to write that off, understand it, sell it for a loss, take the loss, or reinvent it to do something else with it. Well, you can imagine that's a long time of processing. And it could get worse and worse and worse. And guess what? As an investor, we borrowed money for those buildings. And when I go below a certain ratio, the bank says, you got to pay me the whole amount. Or the balloon, what's called a balloon payment, you had a 5-year balloon and it was amortized over 30 years, the rate of it monthly over 30 years, but you now 5 years later have to pay the balance. Usually it would be refinanced under normal conditions.
Right.
But now the value of the building is so much less, the bank's just saying you got to pay me.
Right.
And so what will happen is called default. And that is this. I'm losing it anyway. I'm not paying the bank. Basically, I default and I just give to the bank the building.
This empty building, yes.
I defaulted. And
that was their collateral instance, yeah.
Okay, now guess what? That's why remember we just saw that list of commercial real estate? If I got a lot of that called mid and high, the likelihood of me, the bank, having a
lot of loss,
non-performing asset is high, and that is counted against my ratio, and that's why probably the companies with the high real estate stuff is going to their Texas ratio is going to get worse and worse.
The less stable banks right now.
Less stable banks, but the economy is going to get triggered into a more severe recession, which means unemployment, layoffs, your ability to earn income and make investments is going to trigger and be difficult. So as you start to see that, it's going to change. And the question is, number one, what's the stability of my company?
Right.
That I need to be aware of and either move already or at least build up my savings because I need to get prepared for they could lay me off. And I need to reconsider where I'm at financially and build up. And remember, God says in Scripture, the wisest animal on earth is an ant. And why? Because it saves up in the summer for the winter.
Right.
And it says, so be that way. Be as wise as an ant. And when you're doing okay, save up, build some savings. Consider maybe having to make a change or get prepared to make a change ahead of the game and get to a more stable situation. Come up with an alternative. And your investments would be what you've been accepting as normal may not be normal. And there's two elements of that. One would be diversify it, which by the way we just discussed with Silicon Valley. They themselves didn't diversify.
Right.
And they got caught in the downturn. And because they didn't diversify, they didn't have any options. They lost it all, basically. Right. So think of that on a personal level, is that I've got my investments in stock market or this or that.
And this is where you talk about hedging some, when you've got certain high-risk things to have something that balances that in your portfolio.
Yeah, and so have a diversification, different things. And then two is hedge it with things that when the economy, particularly the more severe it goes, the higher this alternative investment goes. Like, for example, with what's called metals, gold and silver, if the economy just tanks, the value of gold and silver goes skyrocketing. So am I going to put all my money in gold and silver? No. If I put 15, 10, 20% in that, well, that covers the potential loss if I didn't catch it in time.
Right.
I can still be good. And by the way, if I'm diversified, I'm going to balance that out anyway. And my goal is more what we call principal protection, not maximizing return. Because if you try to maximize,
I ask a question?
Go ahead. Yep.
Regarding like the hedging in terms of metals.
Yep.
And if I'm asking things everybody else on here already knows, I apologize. But hopefully there's somebody else who needs this information too. Is that the sort of thing, I'm assuming that, like my dad used to always do this, you would actually want to buy the physical gold coins and the physical silver coins. You're not talking about investing in a stock in gold.
Right.
Because you're talking about having the physical on hand.
Yeah, because physically you now control it.
Right.
and can do something
Yeah,
with
so I
it.
just wanted to bring that clarification.
It's better. And if you just even invest in it, that's better than not investing in it. But you got to have some physically, just because now you have it and can decide what to do with it, and nobody else can say, well, I know you have this stock, but our company just went under and we can't support it, or we can't fund it. So it's just about wisdom. Of how do you process that, and it's not, again, to operate out of fear, but rather to keep understanding. And what we're trying to do is, I believe God's saying to us, you and me, in our ministry, is at least tell people things that they can observe, like the Texas ratio, for example.
Right.
Well, I'm not going to advise you on what you should do with it. I'm just telling you it would be wise to go look at it, process it, get people around you that
ask God what he has to say.
Ask God what he has to say about that, and then decide what do you do next, and just keep getting truth. He says my will is based upon the truth.
Right. But I appreciate you giving this, this is financial wisdom that a lot of us were not taught. And so to have some of these tools at our fingertips is very helpful, I think.
Yeah,
in terms of more information to process and to ask God, what do we do with this?
Yep.
But knowing how to process that, I think, is an important thing.
Yep. And then on the investment side, my advice would be to go get a professional advisor who is motivated by you paying him just to be an advisor, not by paying him to give you product that he makes money on, because then he's not neutral and he's not independent. And what you need is a professional helper that can say, and what I say in my investor advisor is, what's your philosophy? Well, if he mirrors my philosophy, which is we're going to diversify, we're going to hedge, and Rich, if you want me to maximize your earnings and get the highest risk possible, I'm not the guy, because I don't believe in that. Okay, great, I can talk to you.
Right.
If either I don't have a philosophy or I just want to make as much money as I can for you, no.
Because that's also not what you're looking for.
Right.
Yeah.
And anybody, and so you don't even have to have lots and lots of money. There's people that will help you. But this is a tricky thing, and we're not, even I can understand it, but I don't have the energy, time, and process to make all those decisions. So I need somebody to do that for me.
Right.
By the way, I make the decisions, and God confirms those decisions, including there's been times in the last 4 or 5 years God said, you need to liquidate all your stock. Okay. And by the way, it proved to be a good thing. Now, my advisor even then said, gee, are you sure? Yep, I'm sure. Why? Because God said so.
This is what God said to do, right?
So he's got the wisdom, and we can seek it. And the cool thing is it's individualized. There's no universal answer. There's just there is truth, and that is diversification, hedging, wisdom. That's all true per se, but specifically it has to be played out individually.
Right.
So,
and God's instruction to you personally, he knows what your circumstance is, what you're going to hit up against, who around you is has different resources, what your network, your community is even. So he will direct you in a very personal way in all of this as well.
Yep.
But these tools are so useful in just sifting through that information.
Yeah. And part of it is born again out of the covenant. And that is, God says, I'm going to bless you to make you a blessing. And see, there's no limit to that. It's like, well, you got to make a certain amount of money. No.
Right.
You got to be in a certain industry. No. Hey, I got to not be laid off. No. It's none of that matters to God. He says that none of that matters. I can show you, but it is going to be based on truth, and you're going to have to let me show you the truth, pursue the truth, like the Texas ratio. Well, there's a truth about that.
Right, exactly.
And if you got a high Texas ratio, at least say, should I be concerned about this?
Right.
And God could say, no, don't worry, it's fine. Okay. But at least ask the question, because you pursued truth. And God will show you the answers. And so keep processing with a desire and understanding God's going to deliver the covenant, and nothing limits him. Nothing is too difficult for him. So it's a beautiful thing. So we'll pick this up again next time, and I'm glad you made us kind of go through this exercise, because you can talk about it.
Yeah, but a little nitty-gritty practicing it helps.
And then, well, how do you do that? And quite frankly, the way that you and I were even trying it, we would have just said to heck with it. We can't get there, but we finally did, and God said, here, share that. So everybody can, and we just urge you to do that. And so we'll pick it up again next time of what's happening. But there's lots happening, and it's just pay attention and be and caring about that. So we'll pray about that. Yep.
Excellent. Well, thank you so much. Thanks for sharing this, and I appreciate you getting in the nitty-gritties with me here as we navigate this. So thank you for joining us. If you have questions, send them in at questions@afjministry.com, and we'll be sure to tackle them.
Yep.
Have a great day.
Yep. See you soon.
Thank you for joining us for today's episode of Come and See, your podcast for truth in a world of chaos. Brought to you by All for Jesus Living Waters Ministry. Send us your questions and comments, and tune in tomorrow for more answers to your personal questions about living life in God's truth. Remember, God's will is best and none better. His truth brings peace in this world of chaos.